In today's episode, I'll talk about three stories. In the first story of the day, I'll talk about how RBI's new liquidity rules have given banks a big breather and how it all started with the fall of a bank in California. In the second story, I'll talk about how India's diamond industry may soon be losing its shine and why that matters far beyond just the city of Surat. And in the third and final story of the day, I'll talk about why India put a 12% tax on imported steel and what it tells us about global dumping, trade tensions, and the fight to protect local industries. Welcome to the Daily Brief Show by Zerotha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is very easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 23rd of April. See, the Reserve Bank of India recently made life much easier for banks, and this is great news for investors as well. To give you some context, on the 21st of April 2025, the RBI released its final rules on how banks should manage their liquidity coverage ratio, which is also called LCR. And the reaction to all of this was quite instant. Bank stocks rallied and Bank Nifty index hit a record high the very next day. And that is because the final rules turned out to be far more relaxed than what had actually been proposed earlier. But in order to understand why exactly this even matters in the first place, let's first understand how we even got here. See, this whole conversation around LCR in India really picked up after the collapse of the Silicon Valley Bank, or SVB, in the US back in March 2023. You might remember it. Now, SVB, for your context, was not just any regular bank. It was almost like a go-to bank for many startups and tech firms. But when panic struck, depositors clicked a few buttons on their phone and billions of dollars left their bank almost instantly. And that kind of a digital bank run caught regulators off guard. Basically, the entire idea that deposits could disappear so fast was something banking systems around the world had not fully planned for. And that is where the concept of LCR becomes really important. Now, the liquidity coverage ratio, or the LCR like you know it, is a global rule that says that every bank must keep enough high-quality liquid assets, which means things like cash, reserves with the central bank, or government bonds, in order to survive a 30-day crisis. If I put it in other words for you, even if a lot of people pull out their money in panic, the bank should still be able to meet those demands without really collapsing altogether. And this ratio must always be above 100%, which means that a bank should have more than enough liquid assets in order to match any sudden cash outflows that may be expected in a stressful period of time. Now, back to the story. In July 2024, the RBI released a draft proposal suggesting some big changes to how LCR should be calculated in India. And the thing is, it did not really go down too well with the banks. One of the main suggestions in the draft was to increase the assumed runoff on digital deposits. Now, for your quick context, runoff is a term that is used to guess how much the bank's deposit base might get withdrawn during a period of crisis. Let's understand this with an easy example. Imagine a bank has about 1,000 crore rupees in deposits, and the runoff rate is, let's say, 5%. So that means that you are assuming that 50 crore rupees might be pulled out by the people who have deposited money in a period of panic. But the thing is that in a world of mobile and internet banking, those numbers can really change drastically. The RBI proposed that any deposit, right from individuals or even small businesses, which can be accessed through a mobile app or a website, should be treated as far less stable than other ones. They basically doubled the runoff rates from 5% to 10% for these stable digital deposits, and from 10% to 15% for less stable ones. And this basically means that banks would need to keep more of their money locked away in safe and low return assets, which basically leaves them with much lesser amount of money to lend and potentially hit their profits. And that was not even all. This draft also said that even top rated government securities, which is the safest kind of assets by the way, should not be valued at full face value. And instead, their value should actually be marked down in order to reflect real market prices, with a bit of a haircut in order to account for volatility. Now, this entire scenario, of course, was heavily inspired by the Silicon Valley Bank episode, where bond values dropped sharply due to rising interest rates, which made even safe assets very risky under a period of stress. Another change was about how banks treat fixed deposits, or FDs, which are pledged as collateral. See, until now, FDs which customers cannot withdraw early were considered fully safe and were excluded from LCR calculations. But the draft actually said that if a customer pledges an FD against a loan, the bank should actually assume that the money might really be needed at some point, because if the borrower at any point in time defaults, the bank may have to break that FD. So basically, those pledged deposits should now count as potential cash outflows as well. Now, banks were basically expected to implement all of these changes by 1st April 2025, and that gave them less than a year to get their systems ready and start holding more high-quality assets. Analysts believe that the new rules could drag down reported LCRs by 11% to 18% across this entire sector. Some banks, which previously sat safely above the 100% threshold, might have dropped below it under these stricter assumptions. Then there was also a side effect in the bond market. See, since the draft rules would have pushed banks to buy more government securities in order to meet new LCR norms, bond yields actually dipped in anticipation of it. More demand for bonds meant prices went up, and yields as a result of it, of course, came down. To give you a reference, India's 10-year bond yield even hit a 2-year low around the time the draft was released. But banks were not too happy about it. Through the Indian Banks Association, they pushed back and they said that the 5% extra runoff on digital deposits was too harsh and they suggested it to be halved. They also requested more time beyond April 2025 to comply with all of these changes. Now, their argument here was very simple, and they said that if too much money is tied up in safe assets, there is less available amount of money for loans, and that, of course, could slow down credit growth in the real economy. So with all of that happening, eventually the RBI responded, and by late 2024, there were signs that the regulator was softening its stance, especially after the government also stepped in and flagged the possible impact on lending. And then came the final guidelines that were released on 21st April 2025. And to everyone's surprise and also relief to a great extent, the RBI went easier than expected. First, the controversial digital deposit rule was relaxed. Basically, instead of a full 5% increase, banks now only have to assume an additional 2.5% runoff for deposits with internet or mobile banking access. So instead of basically jumping to 10% and 15%, the revised rates are now 7.5% for stable digital deposits and 12.5% for less stable ones. And considering that about 85% of deposits in most of the banks are digitally enabled, this change significantly reduces the pressure that the draft had earlier created. The second was a brand new concession which was not even mentioned in the first draft. Basically, the RBI said that wholesale deposits, which is the kind of money corporates, trusts, or large associations park with banks, would now have lower assumed runoff if they come from non-financial entities. These deposits will now attract only a 40% runoff instead of the earlier 100%. And that is a big reclassification. It basically means that these deposits are being treated as more sticky or reliable than ever before. The other proposals like haircutting government securities and treating pledged FDs as outflows still stand there. But there was one more major relief, which was a delay in implementation. Instead of April 2025, these new rules will actually now start from April 1st, 2026, and that gives banks a full extra 1 year to adjust, whether that's by slowly building up more HQLAs or restructuring their deposit profiles. So I'm sure with all of this information, you are definitely curious about the impact of it. So let me quickly touch upon that as well. See, an internal RBI study that was based on data from December 2024 found out that if these new final rules had been in place back then, the overall banking system's LCR would have actually improved by around 6%. More importantly, every single bank would have stayed above the 100% minimum, which is something that would not have been possible under the draft rules. In fact, the benefits do not even stop at compliance. By easing outflow assumptions on wholesale deposits, banks would now end up with more excess liquidity. And this freed up money, which would otherwise have sat in ultra-safe, low-yield places, can now be deployed more efficiently. It can move from cash or short-term treasury bills, which by the way return about 3 to 5%, to more higher yielding assets like loans, which by the way fetch 8 to 10%. And that shift, even if it is fairly modest, helps with profitability for banks. According to estimates from ICRA, the new rules could free up 2.7 to 3 lakh crore rupees of extra lendable funds across the banking system. Morgan Stanley believes that this could boost loan growth by 1 to 2%, and while the net interest margin impact might seem small of just a few basis points, every little bit over here helps. CLSA estimates a sector-wide NIM improvement of about 0.03%, while IIFL suggests that it could be much higher for individual banks depending on how much liquidity they choose to hold above the required 100%. So basically, what started as a strict post-SVB cleanup exercise has now turned into a more thoughtful recalibration of sorts. And hopefully, all of this is a good outcome. On that note, let's move on to the second story of the day and talk about India's diamond industry. See, India's diamond industry is currently facing its worst slowdown in 2 decades. In the financial year that just ended, polished diamond exports from India dropped to 1.1 lakh crore rupees, and that's not just a sharp fall, it is the lowest figure in the last 20 years. And this number alone is very worrying, but what makes it really painful is the ripple effects that it is having on people, on cities, and export earnings that depend on diamonds to survive. But to really understand why all of this matter, like always, let's start from the very beginning, which is where diamonds really came from, how they reached India, and what changed recently in order to bring this industry to a grinding slowdown. See, for your understanding, diamonds start forming more than 100 kilometers beneath the Earth's surface. Over millions of years, heat and pressure turn simple carbon into crystal, and these crystals are then pushed closer to the surface during rare volcanic eruptions, specifically something known as kimberlite eruption. And once these rocks reach the surface, miners in countries like Botswana, Russia, and Canada extract them from the rubble. But these are not the shiny stones that you and I see in jewelry. These are actually called rough diamonds, and they look like cloudy pebbles. Now, these rough diamonds first go into trading hubs like Antwerp in Belgium or Dubai, and that is where dealers evaluate every single stone, where they check for color, clarity, and carat weight, and then buy and sell them in batches. After that, nearly all of these rough stones make their way to one place, which is Surat in Gujarat. Now, Surat, for your context, is not just any other city, it is like the global nerve center of diamond polishing. Over 90% of all the polished diamonds in the entire world are cut and polished in Surat itself. The city has more than 5,000 polishing units, and it employs more than 8 to 10 lakh workers who really specialize in turning these cloudy stones that I spoke to you about into brilliant gems that you and I use in jewelry. Basically, my point is that no other place in the entire world comes close to Surat in terms of scale, cost efficiency, or even skill for that matter. In fact, diamonds are so central to Surat's economy that some reports suggest they make up as much as 80 to 90% of the entire city's industrial output. But the problem is that that shine has now started to fade. In 2021-2022, India's diamond trade was at its peak. We exported polished diamonds worth 2.92 lakh crore rupees, which is more than 40 billion US dollars. Now, in a typical year, here is how the math would work. India would import around 90,000 crore rupees worth of rough diamonds, process them in places like Surat, and export the polished stones for about 1.5 lakh crore rupees. Now, the difference, which is roughly around 60,000 crore rupees, would go into paying workers, electricity bills, loans, and even for profits. Now, last year though, that profit margin shrank to 21,000 crore rupees. And the reason for this was that the prices of polished diamonds have now started to collapse. One of the biggest price trackers in the industry, which is called RapNet, you can almost think of it like a Sensex of diamonds, showed a 20% fall in diamond prices in the year 2023, followed by another 14% drop in the year 2024. And to make things even worse here, rough diamond prices have also come down, but not by enough to make up for the fall in finished stone prices. So margins basically are squeezed quite badly at this point. And because of this, many factories in Surat did not reopen after the 2024 Diwali break. According to Gujarat Diamond Workers Union, around 2,000 small units, or roughly 40% of Surat's polishing industries, are still shut right now. Even the factories that did reopen had to cut working hours and even slash salaries. Workers who once used to earn 40 to 50,000 rupees a month are now earning just 15 to 18,000 rupees. Union leaders are saying that this is a sharp drop in income and it has caused immense stress, and they have linked it to nearly 70 worker suicides over the past year and a half. Now, the thing is, this slowdown did not come from one single reason. It is actually the result of 4 major shocks that hit the industry, and sadly, all at the same time. The first one was the geopolitical issue, which is the Russian diamond ban. See, until recently, many Surat factories would buy rough diamonds from Russian suppliers, they would polish them in India, and they would sell them abroad without any trouble whatsoever. Even if the stones were mined in Russia, they could be marked as Indian origin after they were processed in Surat. But starting January 2024, that loophole was sort of closed down. The G7 countries, which was led by US and European Union, banned all diamonds that come directly from Russia. Then from March 2024, they took it a step further also. Even diamonds that were mined in Russia but were polished in a third country like India were also banned. Now, in order to export to these G7 countries, diamonds must stop at an approved verification hub in Antwerp and carry proof of their exact mine of origin. Basically, if there were no papers, there would be no entry. And that is a huge deal because the US and Europe together buy nearly 70% of the world's diamond jewelry. And because it is now sort of risky to sell anything that may have Russian origins, the demand for Russian rough has collapsed even though India itself has not banned these imports as such. And with so much uncertainty going around, many importers have also chosen to reduce purchases altogether. And that, mind you, is just reason number one of why India's rough cut diamond imports fell by 24% just last year. The second big blow was weak global demand, especially from the US and China. Now, for your context, the United States alone buys more than 30% of India's diamond jewelry. But in the past year, Americans have been spending less amount of money. Inflation has made weddings a lot more modest, and 1 in 5 engagement rings in the US now has a lab-grown diamond instead of a natural one. Now, these lab-grown diamonds look almost exactly the same, but they cost 60 to 80% lesser. Now, Surat does polish lab-grown diamonds as well, and they even exported about 10,700 crores worth of LGDs last year. But as you would imagine, that is nowhere even close to what was really lost on natural diamonds. And what made it even worse is that things in China were not any better either. The country's property market slump has made consumers very wary, and instead of splurging on jewelry, they are now sort of shifting to safer assets like, let's say, gold. And that has taken away what used to be the second largest market for India's gems. The third issue was a tariff scare from the United States. See, on March 28, 2024, the US announced a potential 27% import duty on Indian diamonds starting April 9th. Wholesalers rushed to place orders before the deadline, which basically gave India a slight export boost in the month of March. But then the US paused the tariff for 90 days, and all of a sudden there were no new orders. Indian exporters were left with empty shelves and no April sales. And that brings me to the fourth and the final problem, which is the inventory build up. See, with so much unsold stock and dropping prices, diamonds are piling up in the Indian warehouses. According to Global Trade Research Initiative or GTRI, the gap between how many rough diamonds India is importing and how many polished diamonds it is exporting has really widened significantly from about $1.6 billion in FY 2022 to $4.4 billion in FY 2024. And this pile up is creating one more headache. In the diamond business, traders usually use inventory as collateral to get bank loans. But now banks are pretty nervous. After the series of high-profile default and fraud cases in the entire industry, lenders are demanding much more guarantees. They are also skeptical about accepting diamond stock as collateral because it is hard to value and harder to sell quickly. And all of this is not just a Surat story, mind you. The diamond industry supports nearly 10 lakh workers directly and around 20 lakh more indirectly, which are people who drive trucks, sell tea outside the polishing units, maintain machines, insure shipments, or even handle logistics for that matter. And when 2 lakh polishing seats go empty all of a sudden, entire local economies get affected, right from rents dropping to bus fares disappearing to grocery sales falling and whatnot. And even if you talk about a national scale, this slowdown is a big red flag. The gems and jewelry sector still earned India 2.37 lakh crore rupees in export last year, but that is a sharp fall from around 3 lakh crore rupees 2 years ago. And when that foreign exchange income falls, India's current account deficit also starts to widen. And then India has to borrow more in dollars or cover the shortfall by spending more on important things like oil or electronics. A thinner foreign exchange cushion also makes the rupee much more vulnerable during global energy shocks. So yes, while at first look, it definitely looks like only a story about diamonds, but the thing is, if we just dig a little bit deeper, it's actually a story about livelihoods, about trade, about global demand, and even economic risk. And at the center of all of this is the city of Surat, which is now finding itself struggling to catch up. On that note, let's move on to the third and the final story of the day. India has recently taken a very big decision in the space of steel, and it could really affect how our country builds everything right from bridges to buildings in the months ahead. To give you context, a few days ago, the government announced a temporary 12% tax on certain types of steel being imported into India. And this tax will be in place for the next 200 days. The reason is that Indian steelmakers are struggling to compete with cheap steel that is coming from abroad, mostly from countries like China, South Korea, and Japan. Japan. And this new tax, which is also called safeguard duty, is meant to protect Indian companies from getting crushed of sorts. But let's take another step back and understand what's really going on here. See, even though India is the world's second largest producer of steel, something odd has been happening as of late. We have been importing more steel than we actually export. In 2024-2025, India bought in about 9.5 million tons of finished steel, which is one of the highest levels that we have seen in nearly a decade. Meanwhile, on the other hand, our steel exports have actually dropped during this time. So in very simple terms, more foreign steel is actually coming into our country and less Indian steel is actually going out. And that, of course, is not great for Indian manufacturers as a news. And the big reason this is happening is something called dumping. And that's basically when a country sells goods abroad at prices so low that local producers just cannot compete with them. Countries like China usually end up producing more steel than they need, and when their economy starts to slow down, instead of cutting back on production, what they start to do is that they start exporting that extra steel at dirt cheap rates. And in this case, Chinese steel was being offered at about $460 to $480 per ton. And even after adding import duties and transport costs, the landed price in India came to around 44 to 45,000 rupees per ton. And on the other hand, Indian steelmakers were selling similar products for around 51 to 52,000 rupees. Now, for manufacturers who use steel as raw material, that kind of price gap makes a big difference. And this was slowly becoming a big problem for Indian companies. Major players like JSW Steel, Tata Steel, and SAIL, which is SAIL, have been warning for a while that the situation could get out of hand over time. And they were not just imagining it, they were also seeing the real world impact, which is having to lower prices, reduce production, and in some cases even face losses. Now, most of this steel was actually coming from China, South Korea, and Japan. And these three accounted for nearly 80% of our total steel imports. China used to be the biggest supplier, but it was recently overtaken by South Korea. And meanwhile, another new player entered the scene, which is Vietnam. In 2023-24, Vietnam sent almost 1 million tons of steel to India, which is up from practically zero just a few years ago. And that made Vietnam the fourth largest steel supplier to India all of a sudden. And Vietnam, just like Japan and South Korea, has a free trade agreement with us, which means that steel comes in without import duties. But China did not have such an agreement with India. But even then, its steel was so cheap that it could still compete with Indian companies even after paying a 7.5% basic import duty. So the question then is, why did the government act right now? See, back in December 2024, the Directorate General of Trade Remedies, which is the authority that looks into such trade issues, began a formal investigation into whether India should impose some kind of protective measures or not. And by March 2025, they had enough evidence to say that our country was facing a sudden and a sharp increase in imports and that this posed a serious threat to local manufacturers. Now, that specific phasing, which is sudden and sharp, matters. See, under global trade rules set by the WTO, this is one of the conditions that is needed to justify a safeguard measures like this temporary tax. But there's another layer to this as well. Around the same time, the US and China were having fresh trade tensions. Basically, the US has kept a 25% tariff on steel imports since 2018. And now, with new restrictions being considered in Washington, there was concern that Chinese steelmakers would redirect even more of their cheap exports to countries like India. And the risk was very clear that if India did not really act fast, it could become the world's dumping ground for steel that nobody else really wanted. But it's not like India is the only country doing this. See, across the world, governments have actually been taking steps to shield their steel industries. Between 2019 and 2023, over 120 trade measures were introduced globally to stop steel dumping. Earlier this year, Malaysia imposed anti-dumping duties on certain steel products from China, India, Japan, and South Korea for a 120-day period. So India's move is very much in line with what is exactly happening worldwide as well. But that said, this new tax does not really apply to all kinds of steel. It is targeted and very selective. Specialty steel products like electrical steel, which is used in transformers, tin plate, which is used in packaging, and stainless steel are exempt from this. Now, these materials are either not made in large quantities in India or they are highly specialized and not part of the dumping issue as such. Plus, stainless steel was not among the products whose imports were surging in the same way as basic carbon steel. Then there is also a price filter that is built into all of this. If the imported steel is priced above a certain level, which is $675 per ton for a hot rolled steel or $964 per ton for colored coated steel, it will not face the 12% duty. And that way, only the suspiciously cheap imports are being targeted. Also, by the way, this is not the first time India has taken such steps. Between 2015 and 2017, India imposed a mix of minimum import prices and safeguard duties to counter a very similar surge in Chinese steel. Back then as well, dumping was the main concern and steel imports had shot up by over 70% in a single year. Now, the Indian government's approach to steel trade has always swung between open and being protective, depending on market conditions as such. And this time around, it seems that we are in another protective phase of sorts. Now, with all of this gyan that I've given, I know a lot of you might be really thinking that steel is not really exciting. But the truth is that it is one of the most critical materials in our economy. Whether it is roads or railways or power plants or even factories, steel is like the invisible backbone that is behind all of them. So for a country especially like India that is still building rapidly, the health of our steel industry really matters quite a bit. And that is why this new tax is more like making sure Indian steelmakers have a fair chance to compete, survive, and even possibly grow. But with all of that said and done, there is still one question that remains unanswered, which is what happens after the 200 days are over? See, that really depends on what the DGTR finds in its final investigation. If they believe that the problem has eased out, the tax could really be rolled back. But if they find that dumping is continuing to pose a threat, they might recommend a longer-term measure. A lot will really depend on how global prices move and whether India's own demand for steel continues to grow or not. That brings me to the end of the 3 stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, South Korean electronic giants Samsung and LG have moved the Delhi High Court against India's revised e-waste pricing policy, which mandates a floor price of 22 rupees per kg for recycling. The companies argue that this rate is 5 times higher than existing market prices, which significantly raises their compliance costs. Second, India's core sector output rose by 3.8% in March 2025, up slightly from 3.4% in the month of February, according to data released by the Ministry of Commerce and Industry. This uptick was driven by strong performance in cement, steel, and electricity. Third and the final one for the day, Reliance Industries has purchased government securities worth an estimated 7,000 to 10,000 crore rupees from the secondary market during the second week of April, following the Reserve Bank of India's Monetary Policy Committee decision to cut repo rate by 25 basis points on April 9th and shift its stance to accommodative. The purchases were made on and around the policy day, with private banks also participating actively. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and I will see you tomorrow. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.